Hello, everybody. Kirk Spano, and I am here on October 13th, 2022, Thursday the 13th. And we have some new content up at Fundamental Trends as well as at Margin of Safety Investing. I am going to go through a little bit of it with you. First off, the fourth quarter plug and play stocks is up and has some minor changes, so keep an eye on that. Don't go rushing in. As you'll learn in just a minute, I am becoming a little bit more pessimistic in the short run. Still love the long-term thesis for the things that we like, but I think we're going to get really good prices here pretty soon. Shooter's risk on, risk off report, which I'll be republishing at Margin of Safety here this afternoon or tomorrow for the weekend, is up as well. This really covers the big picture in the stock market, and we changed it to just be a monthly piece because it really is longer term timeframes. So I will get these charts up for everybody at Margin of Safety because this is really what matters to you. And then I published a new article on using global trends ETF, and I'd like to thank Nicholas. So I want to go through it with you really quickly. I think that it's important that you segregate out different portions of your portfolio. I know that over at Fundamental Trends, when we talk about trading, we always say, hey, only trade 5 to 20% of your portfolio. And if you're going to trade 20% of your portfolio, that should include a lot of growth that you had on your tradable portion. Shooter and I both started off trading less than 10% of our portfolios. That grew, so now we trade a little bit more. Him probably quite a bit more than me. But trading is just a slice or a sleeve within your portfolio. So what I talk about in this piece is how to segregate out your portfolio into different slices. And I've used the word sleeve before, but I think people understand slices better. I mean, there's a whole website on it now. So I think that this is a great way to look at it. And so I rewrote this article for you. So really, you're going to have three major slices in your portfolio: the cash portion, the core portion, and the tactical portion. This is the way that I've always done things. I adjust my risk based on how much cash I hold. So when I hold 30 or 40 or 50% cash in this slice, in this bucket, all sorts of different words, it is money that is not at risk. And this year, cash was not trash. The value of the dollar went way up, and it is now creating a situation where things that we would like to buy, particularly in the emerging markets or related to the emerging markets, which is where 80% of the global growth is. And that's not a made up number. We are at about 80% of all global growth is in the emerging markets now. So we want to be very cognizant of what we invest in. So if we have a lot of cash right now, that means as these emerging market securities prices go down because the dollar is getting stronger, we now have the ability to allocate into emerging markets assets or tech assets or other things that we like. Your core holdings, you probably won't change much, but as you raise cash, you reduce these proportionately. And your tactical holdings will be more your sector-based investments, your country-specific investments, industry investments that you may get rid of completely for short periods of time. And again, that goes into your cash slice. So as your cash slice increases, you're lowering your risk. Proportionately, these portfolios can stay similar. So these are the three big slices. And just to go through it with you again, right now, your cash slice, which will have ranges on cash depending on the type of investor that you are still at relatively high levels of cash. You'll notice that the multiple here from the low to the high is 10. From here it's 8, and from here it's 6. This is imperfect, but if you're a defensive investor, you could probably go as high as 60% cash at some point. Not often, but it is, I think earlier this year, if you were 60% cash, I know some people were 75% cash. For a hot minute I was, that's a really good approach. The reason you really don't go much higher in cash here is that you have to take into account that no matter how scared you get or how pessimistic you get, you might be wrong. So you should keep something invested for the long term. So right now, the aggressive investor who may be swing trading more should be at about 10% cash, but that cash should be falling as the market falls because you're buying more things. Moderate investor, about 20% cash. Again, because we're buying in the fourth quarter, your cash should be falling very slowly. And then for the defensive investor, about 40% cash. Your core ETF slice, and this is for the ETF portfolio. Clearly, you can have stock slices too. Are your more static market cap based investments and broad theme investments. So when we take a look at this, Invesco, QQQ, or iShares Evolve Tech, of this slice, right? Your allocation will always be 100% of this slice. The slice just might shrink. So I'd have about half of my money in the tech weighted investments. Why? The economy is half technology now. So it's not out of line to have half of your portfolio in tech because that is actually what the portfolio dictates based on size of the economy. Berkshire Hathaway is our substitute for the S&P 500. They have operating companies. They have cash to buy back their own shares. So it's essentially going to track the S&P 500 on the upside, but when the market is bad, they're going to do much better. The Invesco Midcap Momentum Fund has beaten all the other momentum funds over multiple time frames. It's a very simple quantitative strategy. It sells the losers and rides the winners in a systematic way that would be very hard for you to duplicate without owning 50 to 100 stocks that you are managing. So this portfolio does a lot of that for you. So to get your mid-cap exposure, I have looked for other strategies, and this one just beats them all. So I stick with this. Clean energy. This fund is more of a large cap fund in clean energy. You'll see on the tactical side, we own other funds, but this is kind of a core holding in clean energy, emerging markets, internet and tech, right? Technology is a big theme and emerging markets are a big theme. You combine them together. There are a couple of wisdom tree options that I will include for retirees. But this slice, more importantly, is something that might be a quarter of your portfolio, might be half, might be 3/4. It really just depends on you and whether or not you want to be a little bit more active with a tactical ETF slice. So what you can see is on the tactical side, these are ETFs that you may trade a little bit more often, quarter to quarter or semi-annually. These are just trades that you might have to get in and out of a little bit more often. You don't have to do this. The core portfolio, this right here is going to beat the S&P 500. No sweat. I firmly believe that, and all the back testing suggests that this will beat the S&P 500 by 2 to 6 percentage points on average over long periods of time per year. The tactical slice, though, is where you're really trying to hit some bigger numbers. You take a look at what iShares has done with the semiconductor index. The Energy Select has been one of the only winners this year. And on this pullback, I think that we probably should trade it if you're willing to own fossil fuels. Given that a lot of these companies are getting into carbon capture and hydrogen, I don't know. I think that the sustainability ideas are getting very blended now. I think that sustainability, while it was an interesting theme for a while, is becoming less interesting just because it's normal now, right? It's not an outlier. So much money is going into it that you just have to pick the winners and losers again, because simply being in on the theme isn't necessarily going to support you. What you're going to need are ETFs that are focused in slices within their slices of the theme. So Invesco Wilder Clean Energy is something that we would probably own. I don't have the solar fund in this example. I'll actually update that. But I want you to see how you can take your tactical slice and fill it in with more aggressive investments. There's no point in putting non-aggressive investments in here. One of the ones that I really like is the VanEck Digital Transformation ETF. And we'll talk a little bit about why in a second. So I will send you out trade alerts just to give you an idea of what I manage now. Really, it's 8 different portfolios: Global Trends ETF, Retirement Trends ETF, Sustainable Growth Stocks, and then Sustainable Growth Stocks with an ETF slice, which is what a lot of you are doing. Retirement Dividend Income with an ETF slice, and Retirement Income Options and with an ETF slice. So you don't have to have ETFs. You can just build a 20 to 30 stock portfolio if you want, trade options on one of them. But the ETFs really give you, I think, some pretty interesting balance and a way to very easily deal with your asset allocation so that when you want to raise cash, very easy to trim ETFs. In the short run, I want you to wait for trade alerts because I think that we are going to get some very interesting weeks in the market between now and December that we are going to want to buy. So I know that we've been tripping in, but about 2 months ago, I told you to hold off on tripping in so much. Let's take a look at where this bottom actually manifests. Take a look at this video about what the most important secular trends are. If you're just on the right side of secular trends, you're going to make money. So what was in the news today? Consumer price index went up a little bit. This looks like it is the peak of inflation. All the evidence points to it, but the Fed is going to want confirmation. And I don't think they get that confirmation until November. They won't get it this month. And they might not even get it till December. But I think they might get it just before the December meeting. So I'm sticking with my prediction that the Fed raises 75 basis points in November, still talks hawkish. They want to get their correction in to set up a long-term bull market, and they want to stick it to OPEC and Russia. So the strong dollar allows for some geopolitical maneuvering on the part of the U.S. The idea that the Fed is really totally independent, I've always laughed at. They are not. They are part of the larger geopolitical game. And I believe that we are coming to an end game here with Russia. I think that Russia is getting very close to having to decide what they're going to do with Putin and what they're going to do in Ukraine, because they're going to go broke fighting Ukraine much longer. In addition, you have a lot of people leaving Russia and complaining about what Putin is doing. So the right wing in Russia might push for harder. They might get it for a minute, but I don't think that that's what lasts. I think that the people in Russia, as conditioned as they are to just let Putin do his thing, underneath, I believe they've just been waiting for either things to get better there or for a chance to get rid of him. And I think that Putin's pretty much done soon. So with that, the price of energy would come down dramatically, because once Russia moves away from Putin, they try to come back to the West, and that means more energy supply. When that happens, it's hard to know, but I think it's not that far off into the future, probably next year. And that means that inflation is close to its peak. Doesn't mean that we won't have a spike, but it means that pretty much between the Fed pressure and Putin losing his grip and OPEC, I think on the verge of fraying. They have been close to fraying in the recent past. I think that with Venezuela cutting a deal with the United States, that is the first domino. I think that there are going to be several other OPEC states say, you know what, we're just going to produce as much as we can because we need the money and because we want to be on the right side of the United States. I think Qatar is one of those countries. So we'll see. I think Qatar is probably, they've shown to be very independent in the past. I think you're going to see another burst of independence out of them, much to the chagrin of MBS over in Saudi Arabia. So expect inflation to show its peak definitively, I think, in the next couple of months, and that'll be backwards looking. So we want to be looking through the front windshield, not the rear view mirror. This is the rear view mirror. Out the windshield, what's in front of us is this number is going to be much smaller, probably in the December reports, which will come out just a couple of days before the Fed meeting. There's an article or an interview with Ray Dalio. He talks about some of the stupidity in the financial system. I don't agree with everything that he's saying. I think that his risk parity ideas have proven to be just a little bit better than mediocre, and that's why the fund has shrunk, and that's why he resigned. I think he's getting out of the way while the getting is good. I think you're really going to see a lot of reckoning around the world due to leverage in their pension systems, but also that just goes back to the demographic argument that I've made over and over again. Demographics are destiny. These old nations that don't have a millennial generation behind them are really running into problems. That is a main reason why the United States will remain very, very strong, is that we just have a better population set up. And ultimately, there is no shortage of people that want to come here. Eventually, we will let people in. We will change it to saying legalized. I was talking to one of our subscribers yesterday, and he made a great point. He said, look, people all the time say they don't want illegal immigration. So we just have to set up the rules so that we can call it legal. And I think that's what's coming. I don't know if the president has the authority to do some of these things or if it has to go through Congress, but it makes sense to me that we hand out a lot of work visas and start a very long-term process of making these people citizens. The Republicans realize that we need them. They just don't want them to be able to vote. So, you make it a long-term thing that they have to go through to become citizens, and that way they can't vote in the next couple of elections, while the current generation of demagogues on both sides, but mainly the Republicans, in my opinion, look to stay in office and patronize their patrons, right? Give them the tax breaks that they're asking for. What's interesting about that statement is once you let the immigration in, the economy grows. We don't need to raise taxes on anybody. I've said that in the past. There's some tax avoidance that we should get rid of. They kind of did that with corporations with a sort of minimum tax rate. But for the most part, we don't need to raise taxes because our economy should be the strongest out there for a long time. And all we have to do is make sure that the healthcare system doesn't get completely out of whack. We took a step in that direction a couple of months ago by allowing Medicare to negotiate drug prices. Ultimately, and I understand that people want to be pessimistic because the news. But when you look forward on a relative basis, the United States compared to everybody else in the developed world, we just are so much better off than everybody else in the developed world. It's really only the emerging markets that are going to match our growth, and they'll have more growth than us for sure because they have more people. But there's no shortage of those people that want to come here. So we can join in the party. We still have all the advantages that we've always had. And that means that on any of these big corrections, we can buy a lot of good things on the cheap. This was a video that somebody put up in the chat room of Fundamental Trends. It's a great video. Kathy Wood is saying a lot of things that I've been telling you about how the economy is really working, about why a Fed mistake is a big thing to look out for, and then also the international events that we have to worry about. So we're on the same page there. Again, I'd rather trade with Shooter than with Kathy. Shooter is a much better trader than her folks. So if you want to trade some of these ideas, come on over to Fundamental Trends. I believe that the S&P 500 is heading down to this level, right around 3,000 on the S&P 500, 300 on SPY. I think we're just about to drop through. And I think this is going to happen quickly. I think it's going to happen over the next 4 to 6 weeks. It could happen faster, but I think the bottom of the stock market is put in before the December Fed meeting, like just before. So between the end of October, and I say the end of October because just in case the Fed backs off unexpectedly in November, you want to have already gotten some money in. But between the end of October and the start of December, I think that's probably when we get most of our money invested, because I believe this is coming down to here. And at that point, I think the Fed has to say some dovish things in December. If they don't, and we go all the way down into this Armageddon zombie apocalypse, we'd probably take leverage at that point. I think if we get down here, we take our last 10 or 20% of money or whatever it is you're holding in cash, and we take that slice, and we get it down to almost zero, your lowest end, and you probably take a little bit of leverage. That's the only thing I can tell you is if this completely falls out of bed and goes straight down, and we get a SPY in the lower 200s, the Fed's going to come in on a white horse. And I think that would take the form of stopping interest rate increases altogether. And I think it means that they would cut the balance sheet runoff in probably half, go back to where they started. And that would be enough capital to support the entire system because U.S. Treasuries would again start getting bought incidentally by the Federal Reserve. They wouldn't announce QE, but by not running them off, they're going to reinvest in some, and that would support the market quite a bit. If we get down here, which still doesn't look probable without a mistake or a foreign event, you're going to have to hold your nose and invest. And I don't know what more I can tell you is if we get this end of the world event, remember, it's not really the end of the world unless somebody fires a nuke, and then who cares? But I think that this is where you want to be. 100% invested if we get down here. But I think you want to be mostly invested already here. This really wipes out all the excesses from post-COVID. Where do you want to be invested? There was another study that came out, and just like I told you 2 years ago that the millennials ran the stock market, now another study talking about what the millennials are doing. I've talked to you about private equity investing. I've talked to you about investing in real estate. I've talked to you about cryptocurrency, about fintech in general, about the fourth industrial revolution, about decarbonization. Those are the things that the millennials are investing in. They only hold about 30% of their money in the stock market right now versus about 55% for the boomers. The boomers are about to lose a lot of money in the stock market, a lot of money. So you have to bet on things the way that the growing money, which is the millennial money, right? They're earning, they're getting raises. They have 20 years left to work, no matter what they think, maybe 30. And the boomers, for the most part, are retired now. There's a handful that are still working, but they'll be at peak retirement by the end of the decade, and then they'll start to die off. So investing like a boomer is a really bad idea, even if you're a boomer. You need to shift to this fourth industrial revolution, decarbonization, and fintech type of investments. If you have the stomach to invest 6 figures into real estate projects, that's a great way to do it too. If you're an accredited investor, you should really call me because I have some pretty interesting things to show you that you can invest in. They're going to do very well. Right now, there's a pause and a little reset, but they'll do well, especially if we get some discounts because people panic sell. I know one boomer with what he thinks is a $4 million or $4.5 million piece of property. It's worth $3 million. And when the offers dry up, he's going to come back down on price. And I'm just waiting for it. You know, the deal that I'm talking to you about, the one that I tried to buy. People who have the ability to invest in development, people who have the ability to have their money not be 100% liquid, right? Because it's not money they need right now. They can invest truly for the long term. There are real estate and private equity investments out there that the millennials are getting invested in, right? The millennials who earn over $200,000 a year, the accredited investor millennials, they're doing that stuff. And they're also still buying Bitcoin. And they're investing in fourth industrial revolution, and they're investing in decarbonization, just like Exxon and Chevron are doing and Berkshire Hathaway are doing. One of the things I said at the start about the XLE ETF is that it's getting blurred lines about what is sustainable and what's not. You have Chevron, Exxon, Occidental, Berkshire Hathaway, all and Kinder Morgan, all getting heavily into decarbonization, carbon capture, carbon transport, biofuels, things like that. Ametis is our small cap pick in that space because they're going to dominate California, which is, still top 15 economy in the world for a geographic region. So we have to really think these ideas through. I know that the idea is that, it's oil and oil is going to go up because of shortages and blah, blah, blah. Well, we know that there's no shortage of oil, just like I said a year ago. It's Saudi Arabia manipulating the market, and that day is going to end soon. So we have to look at what we want to invest in. And certain types of decarbonization don't jump out at you as decarbonization, but carbon capture, carbon sequestration, carbon transport, biofuels, all those things are forms of decarbonization. And the federal government, right, one of our legs in investing is, does the government support it? The federal government is supporting the carbon capture heavily. That's what this last inflation bill was all about. It was about making energy cheap again and still fighting climate change. So look where the government money is going, to the tunes of tens of billions and hundreds of billions of dollars, probably trillions of dollars when we look back on this in 10 or 15 years. I will just finish with this. If you don't subscribe to Crypto Trade Shots with Shooter, I think you are missing out. You really should be reading this stuff because he does a pretty in-depth piece every week. And he actually does 2 pieces, but we're going to cut it back to 1 just so he has less work to do. And this will be even more comprehensive like it was before. We split this piece up into 2 pieces, or this article up in 2 pieces a while back. We're going to go back to just 1 piece, I think. And then he'll also have what he has on the on YouTube. So I think you should subscribe to Crypto Trade Shots because it'll help you understand what's going on in fintech, even if you don't want to do anything other than dollar cost average in the Bitcoin and Ethereum, which is what I recommend. Just dollar cost average in. You should be doing it right now. I had one guy who sold out, so got back in, they sold out. You should only be trading a portion of your holdings. Remember, slices. Only trade a portion of your holding. But Coinbase, and I don't think that they're a takeover target. Coinbase, I believe, is going to be a pretty interesting company now that they have BlackRock behind them and some of the other things that they're doing. I don't think Google Cloud has anything to do with Coinbase getting bought out. I think that's just Google knowing that Coinbase is going to be around and they wanted the contract. It also speaks to the fact that cloud is just going to keep growing. It's going to grow 5x in the next 10 years, which is why we want to own Microsoft, Amazon, and Google, the three big cloud players in America. I could do it through an ETF. You can buy them directly. I'm pretty certain I'm going to buy Microsoft soon. It's just so rare that we get it cheap, and it might be the safest operating company on the planet. Berkshire is more of a fund to me. They're safer, but Microsoft for operating companies, I think might be the safest in the world. There's just very little that could really hurt them long term. All right, so I think that's all I got for today. I'm really concerned that this happens fast, and I'm semi-concerned that we get a mistake or an international event to get down here. But once we get here, you have to at least get a big hunk of your money invested. And then you hold just enough to be able to take some leverage if we get a spike down on whatever we get a spike down on. But watch this video from Cathie Wood. It's a good one. She's right about most of it. If she were a good trader, hey, but we can just steal ETF ideas from her, right? We can decide which of her stocks we want to own, like Square, right? Or a couple of the other ones. This is a Miller Park hat, I think. Yeah, Miller Park. All right. I will have the Global Trends ETF report for October out this weekend. It has become a little bit more comprehensive because I'm including a lot of charts, and Shooter is giving me some charts. So I'm not going to have a separate article, just going to load everything up into that one. Somebody asked if Bitcoin drops 15,000, where might DApp end up? Don't know, don't care. Really, don't know, don't care. And there's not a way to know because in bottoming processes, you get spikes that last literally hours. So you should be dollar cost averaging into Bitcoin. You should be dollar cost averaging into Ethereum. They're both at prices where you should be accumulating. And as far as DApp goes, the top 12 stocks in that fund are awesome. Coinbase, Square, some of the miners, some of the service companies, some of the software companies. It is the absolute easiest way to get involved in fintech is to buy that fund. And it's cheap. Dirt cheap. Was it $5 right now? If it goes to 4, who cares? You buy more. You need to have scaling in processes and you ignore the noise of the day because neither Shooter nor anybody else can pick a bottom in Bitcoin until it happens. You know that you're very close to the bottom, start scaling it. Because when Bitcoin goes up, it's going to go up a lot. Because the float, think of it as the float. The rich are buying Bitcoin from retail right now. Every single time in history that the rich have bought from the poor regret it, and the rich make more money and get richer. Accumulate Bitcoin and Ethereum the same way that the rich are. Don't think of it as a trade at all. Don't think of DApp as a trade at all. These are great long-term plays that can go up 500, 600, 1,000% over the next several years. That's what you should think about, not 10 or 20% right now. All right. Apply that to everything. All right. Have a good day and look for the Global Trends ETF report this weekend. Take care.